Hello, everyone, and welcome to today's webinar, Weathering the Storm, How to Make Insurance Work for Real Estate Investors. My name is Amra Pinkham. I'm the Director of Operations here at New Silver. We are a tech-driven private lender focused on providing fast, reliable, and flexible financing to real estate investors across the country. Here at New Silver, we work with hundreds of investors each year, and we've seen firsthand how insurance can either protect the project or become a painful and costly blind spot. So today, it's all about helping you get smarter and more strategic when it comes to protecting your assets. I am joined today by Ron Maurno here with Steadily Insurance, who brings a ton of experience in the insurance space, and I'll give him a few seconds to introduce himself.
Thanks, Amra. Hey, everybody. I'm Ron, Chief Growth Officer at Steadily. We're an insurance company dedicated to real estate investors. Our insurance advisors work directly with real estate investors to help insure their investment properties, and they also work with our partners like New Silver to help their borrowers with the property insurance side of things. I've been in the insurance industry for about 15 years. As most people have probably noticed, these are some of the craziest times we've ever seen. So hopefully I can be a little bit of a resource for you and maybe share a couple of things that might help navigate it.
Awesome. Well, thank you very much for that. All right, let's get started. Today, we're going to be walking you through 5 key topics when it comes to insurance. We're also going to save a few minutes at the end here for some Q&A. So feel free to drop your questions in the chat as we go. All right, topic number 1 is the critical role of insurance in real estate investing and lending. So we're just going to start off with the basics here. Why is insurance such a big deal in real estate investing? In very, very simple terms, insurance is your safety net. Whether you're rehabbing a property, holding a rental, or building from the ground up, something can always go wrong, and realistically it does go wrong sometimes. From a lending perspective, we do require insurance, not just to check a simple box in underwriting, but to protect your asset, your investment in our capital. A flood, a fire, a liability claim can derail your entire project. What we've seen over the years is that investors who prioritize strong insurance coverage tend to recover faster from setbacks, avoid massive out-of-pocket expenses or costs, and overall just build stronger portfolios. Ron, from your perspective in the insurance world, how do you see investors either leveraging insurance well or maybe making mistakes that come back to haunt them later?
Yeah, it's a great question. And Amra, to your point, I think at the most basic level, the most critical role insurance plays in real estate investing is it's actually what enables the sector to be investable for both investors and lenders, right? If every time a catastrophic loss happened, the investor and the lender were on the hook to cover the whole replacement cost of the property, you'd probably have negative returns in the asset class, definitely a lot fewer investors and lenders investing in the space. So high level, I think that's insurance's role in the sector is to protect against that catastrophic loss and enable the real estate asset class to be investable. In recent years, insurance is becoming increasingly a big deal cost factor and turning some deals upside down that otherwise would have penciled when rates were lower. And I think a lot of folks that are watching this have probably seen that firsthand. So I think those that are continuing to leverage insurance well in this environment are having to acquire a much deeper understanding than before about what they're buying, who they're buying it from, and what trade-offs they're making when they choose to, forgo a certain coverage, tailor a policy to fit a certain price, et cetera. So these are some of the things we'll talk about. Cheaper isn't always better. You've got to understand the risk you're taking. If you're having to take on too much risk to make the pro forma work, then maybe it isn't the right deal. And acquiring that deeper understanding of really where that line is, how much risk is too much risk, that's what I think we're seeing a lot of the investors that are continuing to leverage insurance the right way be able to do in this environment.
Awesome. Perfect. Thank you so much for that. So this is not just about protection. It's about also enabling progress even when things go sideways. So it's very important to have the correct amount of coverage. At the end of the day, this is, again, all about making your investments work for you. So I want to just go over a couple of quick tips to kind of help you guys stay profitable while keeping the coverage in place, or the correct coverage in place. First thing is lock your insurance early to avoid costly delays. A missed coverage window can stall your closing or rehab timeline. And as we all know, in this scenario, time is money. Second of all, think of insurance as your first line of defense. It protects your capital so you can scale with less exposure and fewer surprises. All right. Unless you have anything else to add, Ron, I think we're going to move on to topic 2.
Yeah, sounds good.
All right, awesome. Topic 2 is 3 key factors to consider when choosing an insurance policy. When you're looking at insurance options, I think there are 3 key areas that really kind of deserve your attention here. Getting these right can save you a lot of time, money, and stress down the line. Number 1 is coverage types and limits. What exactly is covered? Is the coverage amount high enough to rebuild or replace the asset if there is a total loss? From a lending perspective on our end here, a lender typically wants the minimum coverage amount to match the loan amount. Second is deductibles and exclusions. What are you responsible for if a claim happens? And most importantly, what isn't covered? For example, we have come across a bunch of policies in coastal states that actually exclude wind damage entirely, which is a major risk in those areas. And in most cases, that kind of exclusion is just a complete deal breaker. Number 3, claims process and carrier reputation. I think you touched a little bit on this earlier, but cheaper policies often come with nightmare claim experiences, right? You want a carrier that's responsive, that's experienced with investment properties, and fair when it comes time to pay out the claims. The claim process can significantly impact your bottom line, so it is very important to choose wisely here. Ron, as far as from your perspective, what are some practical tips you can give to investors when they're reviewing these specific details and anything you'd flag that people often overlook?
Those are really good ones. I'll touch on a couple others. I think another big one is actual cost value versus replacement cost, otherwise known as ACV versus RCV. ACV stands for actual cash value. It means exactly what it sounds like. It's the cost to replace the property minus the depreciation. So in a really simple example, if you have a $30,000 roof, it's halfway through its usable life. It's now worth $15,000. And a hailstorm comes through and wipes out that roof. The insurance company would reimburse you for what it's worth at the time, or $15,000. This is a very simplistic example. There's a couple more moving parts to it in reality, but that's kind of the big picture. Replacement cost is also what it sounds like. It pays you what it costs to actually replace that roof at today's prices. So you get the full $30,000 in that example and a replacement cost policy. We see investors trying to get the price as low as possible, and sometimes they end up going for that ACV policy since it is cheaper without fully understanding what they're buying. And that's a big one where the education really helps. Another one is financial rating of the company. You generally want an A-rated company or better. There's independent agencies that rate the company's financial strength and stability, and really their ability to pay claims, which is what matters at the end of the day. And then the last one that's coming up a lot is admitted versus non-admitted. And what those mean is an admitted company is allowed to sell insurance and operate in the state. And they have to submit all of their policies and rates to the Department of Insurance in that state to get them approved before rolling out a product. And as part of that, the state's guarantee fund could back up the insurance company if they become insolvent and reimburse those policyholders. So that's admitted. They have to submit everything to the state, get their approval on the rates and the policies before selling them in the state. Non-admitted companies are allowed to do business in the state, but they don't necessarily need the state approval on policies and rates, and their claims are not backed by the state's guarantee fund. So in this environment, a lot of investors are noticing that more and more often they're seeing non-admitted options for insurance. And that's because, especially in high-risk zones, it can be really tough for insurance companies to operate profitably while having to get the state's approval for every rate and policy change they have to make, especially when the weather around us is changing really fast. I think a really visible example of this today is the state of California, where on one hand, you've got a big rise in natural disasters, wildfires, et cetera. And on the other hand, you've got the state's Department of Insurance that is effectively making it really tough for insurance companies to raise their rates. So then the insurance company is left with the decision: do I continue to write new policies in the state, knowing that I'm going to end up paying out more in claims than I'm collecting in premiums? Or do I pull out of the state? And unfortunately, we're starting to see a lot of the latter. So that's kind of the difference between admitted and non-admitted, and why I think we're starting to see a lot more admitted options these days, or non-admitted options these days.
Is there a price difference between the admitted versus non-admitted? I assume there is, or?
Not necessarily. In a lot of these areas, the non-admitted gives the insurance companies the flexibility to charge what they need to without having to get the state approval. So sometimes that might in fact mean that they are more expensive because they've been able to raise rates more quickly to keep up with the increased exposure compared to the admitted ones where the state is for whatever reason keeping their rates suppressed. So you might see some of that, but not necessarily one is more expensive than the other.
Okay. All right. Awesome. So these aren't just check boxes necessarily for real estate investors. These factors that I mentioned and that you mentioned as well can make or break an investor's ability to recover quickly if something does happen. A few tips that I can think of to just keep costs down and profits up here is misunderstood and mismatched policies often lead to rejected claims, which can turn a profitable flip into a financial setback. I think you actually touched base a little bit on this earlier as well. Also, one other thing is clear, accurate coverage reduces friction during the claims process and just kind of lets you focus on completing these projects and not having to spend time fighting with the insurance company on what's covered versus what's not. All right, unless you have anything else to add, Ron, I think we're good to move on to topic number 3.
Sounds good.
All right, awesome. Number 3, how do we keep insurance costs low without sacrificing coverage? I think you kind of hinted at this earlier a little bit as well. So this is a big topic. We all want to save on premiums, obviously. We want to keep as much money in our pockets, right? But this should not come at the expense of being underinsured. The risk there is just way too high. I think there are three ways that you can keep costs reasonable without having to give up solid coverage. 3 things that I can think of off the top of my head is 1, bundle policies across your portfolio. Many carriers offer discounts from multiple properties or when combining a builder's risk and a liability policy as an example. Number 2 is increase your deductible strategically. Raising your deductibles can lower your premiums. Just make sure that you cover it if needed. One side thing that I do want to mention here as well is some lenders do have a maximum amount as far as the deductible that they do allow. So definitely double check with the lender before you start this strategy here to make sure that obviously you're not causing any issues there. And number 3 is just working with an insurance broker who understands investment properties. They can always shop around for you for better options and tailor coverage to your projects. I actually can't stress this enough. We've had closings delayed just because the insurance agent didn't know what was needed. A good broker or a good agent will know exactly what to do and get you the coverage without holding up your deal from closing. Cutting corners here may feel like it's saving, but if disaster strikes, you could be stuck with thousands of dollars in lost profit here. And Ron, I know you work with a lot of real estate investors on your end as well. So cost is always top of mind here. So what are some of your go-to strategies for trying to keep insurance affordable while still covering all the right risks here?
Yeah, those are great examples, Amra. I think I'll add a couple more. This one's not that fun to talk about, but if you think about what's driving insurance prices, that's a symptom. And the underlying cause or problem is actually weather and the increase and frequency and severity of weather events, windstorms, hailstorms, wildfires, all those things. So really, at the most basic level, you do have to consider the climate and the weather in the area that you're investing more and more. I mean, if you're in a high wildfire zone, the truth is that house is more likely to burn down than one that isn't. And because of that, you're going to end up paying an arm and a leg for insurance coverage if you can find it. So the area really matters. You touched on this a bit. Using the right company for the risk is a big one. Just to kind of hone in on that a little bit. Some companies specialize more in certain risks than others. At Steadily, all we do is investment property insurance. And all of our tech, our rating models, our actuaries, all of our investment is focused on pricing that risk as competitively as we possibly can while staying profitable so we can continue to write new business. For a company where, for example, their primary focus is renter's insurance or maybe homeowner's insurance, that's where the bulk of their investment is going and optimizing those rating models and those products. And you're not going to have the precision of rates that you would in a company where that is their core focus. So the right companies have niches. This even gets down to like the property itself and what type of condition the property is in. If the property is really clean, like a new build, nothing wrong with the property whatsoever, doesn't need any maintenance, there's certain companies that are going to offer extremely competitive rates. As soon as the property has a couple nicks and dings, a little rougher around the edges, maybe a little yard debris, maybe the roof showing some signs of wear, those companies are going to not offer coverage. You're then going to be dealing with more of the middle market companies, paying a little bit of a higher price. But it's about really finding the right company that specializes in that right type of risk. So I think those are some good examples. I think one thing you can really do is keep the property in good condition. Little things like yard debris, trees hanging over the roof, things that are easy to maintain actually make a huge difference in which company is going to allow you to get a policy through them. And keeping up with those things can make a huge difference on the rates too.
Makes sense. All right, awesome. So I think the key here is finding that balance where you're protected and you're profitable, right? So the biggest tip that I can give in this scenario as well is just doing annual portfolio reviews, just to maybe uncover duplicative or outdated policies. That can, certainly save you thousands over time. I always tell everybody, don't be scared to review your policies. Don't be scared to ask questions about your policies. And once again, don't be scared to shop around, for insurance policies as well, because you never know if you can get a lower rate elsewhere. All right. I think, do you have anything else to add, Ron, or do you think we're good to move on to topic number 4?
Good to go.
All right. Awesome. Number 4, we get this question a lot: builder's risk versus dwelling coverage. What is the right choice? This is one of the most common questions that we get. So what's the difference between the builder's risk and the dwelling coverage? So let's break this down a little bit. I'm actually going to hand this over to you, Ron. You're the subject matter expert here. So if you can provide us with a brief explanation and maybe some key differences between those two policies, we'll start there.
Yeah, perfect. It really all depends what you're doing with the property. A dwelling policy is for having a tenant living in the property. So it's for a non-owner occupied property. So if you're buying a home, you're going to go straight to renting it out, either a long-term rental or a short-term rental. That's what a dwelling policy is for. A builder's risk is for when you're doing renovations on a property. And if you're doing like extensive renovations, especially like adding square footage, moving load-bearing walls, those types of things, you're going to need a builder's risk policy during the course of the construction. And then once the construction is complete, if you're either going to sell the property, you don't need insurance at all. If you're going to convert it into a rental, then you would switch over to a dwelling policy. So that's the difference. Builder's risk is for the renovation, the course of construction phase, and the dwelling policy is for while it's being rented out. There's actually a middle ground between the two also. So if you're just doing light renovations, like cosmetic things, like you're maybe updating kitchen cabinets, you've got contractors coming in and out, but you're not necessarily doing extensive things like adding square footage. That'd be considered a light renovation. And for that, you can actually find a dwelling fire policy with a builder's risk endorsement on it. So it's kind of like a light version of a builder's risk policy. The price is going to be less than a full builder's risk policy. And sometimes it's a little simpler because some companies will let you just remove that builder's risk endorsement once you have a tenant in there, and you can end up keeping the same policy. So those are kind of the differences between the two.
Perfect. I do know just from personal experience as well that this is like a big area of confusion for most people. From your side, what do you think the biggest misconception investors have about like these 2 or 3 coverage types?
I think the biggest one that we see is investors are not sure where that line is as to whether they can use a dwelling fire policy with a builder's risk endorsement versus needing a true builder's risk policy, because that is a little bit gray. It kind of depends on the course of construction, the amount of work going into the project. Each one is a little bit unique. That's where it helps to get an advisor to look at the situation and determine what's the best policy. But that's the one where I think we see the most confusion.
That makes sense. All right, awesome. From a lender's perspective, typically if a property is under rehab or is a ground up, we do require a builder's risk policy. We have seen policies with the builder risk endorsement, and like you mentioned, if it's just light rehab, typically we allow that, so that's not a problem. And obviously, if a property is a rental property, a DSCR loan, as an example, dwelling coverage will be more than sufficient in that scenario. So here, I guess we can ask the question is, how do you make this part of the process work efficiently for your investments as an investor? A few suggestions from my end here is using the wrong policy can void claims, which would cost you again. So you got to get this right from day one to avoid any sort of financial disaster. Number two, and I think this is important, is switch coverage types as your project evolves. So builder's risks during construction, and then move to a dwelling or rental coverage once stabilized to avoid those gaps and overpayment, because builder risk is typically a higher premium than your normal dwelling policy there. All right. Do you have anything to add, Ron, or you think we're good?
Good on my end.
All right. Awesome. We're going to move on to topic number 5 here. And you kind of touched base a little bit on this earlier as well. So climate change effects, what it means for insurance and real estate investors. So we'll talk about the elephant in the room here, climate change. We can't ignore it. We can't ignore what's happening around us. Climate change is obviously reshaping insurance and how it works. More natural disasters, more unpredictable weather, higher risk zones. What does all of this mean for an investor? Unfortunately, it means insurance costs are rising, especially in places like Florida, California, like you mentioned earlier, and other coastal areas. It also means that coverage is harder to get for certain risks like wildfire, flooding, hurricane damage. Higher risk areas are seeing skyrocketing premiums, or carriers are pulling out entirely, like you touched base on that earlier as well. And this is causing real problems for investors in these certain markets. As a lender, we are starting to see more challenges in getting proper coverage in those high risk zones, which honestly can delay or even kill some deals. From an investor side, I think it's all about adjusting your risk models and making sure that you plan ahead. I think it's critical as an investor to, one, know your property's risk exposure. This is not an area where ignorance is bliss plays very well in. You want to know the risks so you can prepare and understand how it's going to affect your profits, whether short term or long term. And obviously, you always want to budget for rising premiums. We want to plan, we want to hope that they're going to stay low, but we want to plan for the increase there. Climate related risks aren't going away, unfortunately. So building your models with this reality in mind and kind of staying ahead of those policy changes are going to be crucial there. And this is a huge and growing concern just across the board. Ron, how do you think the insurance world is kind of adapting to this climate change? And what do you think investors need to be aware of when buying in these areas affected by extreme weather or rising insurance costs?
The big way that they're adapting is either by raising prices or pulling out and not offering the coverages. And that's unfortunate, but it's the reality. I think when you look at how insurance companies operate, a lot of them are running a combined ratio, meaning all of their expenses account for about 97% of their revenue. And so when something changes materially in the environment and they start paying out more in claims than they're collecting in premium, they can quickly become unprofitable. And if that happens too long, they cease to exist. So what you see is they start scrambling to raise their prices, as we've seen, and the prices get more and more expensive. And then you bump that up against what we talked about with the DOIs, and some of them are, I think, well-intentioned, trying to control prices for the residents in their state. But then the insurance company is left with the choice, do I stay or do I go? So in a nutshell, what they're doing is they're raising prices. They're pulling out of riskier areas. The root cause is the increase of weather events. And unfortunately, to your point, Amra, it looks like this might be here to stay for a little while.
Yeah, it is unfortunate. Climate-related risks are growing, unfortunately, but hopefully they don't have to derail your investments too much. I think a few strategic ways to kind of stay ahead of the curve and just keep your returns intact as much as possible is, number one, factoring rising insurance premiums into your deal structuring. I mentioned this earlier as well, as far as budgeting for rising premiums. But if you're buying in high risk areas, you have to adjust your deal margins accordingly. And you have to do this before you even make the offer, just to make sure that you're going to make a profit. Number two that I can think of is just trying to invest in some mitigation features, like maybe some flood vents or defensible landscaping of some sort, or impact windows. These sometimes can lower premiums potentially and maybe boost the property value as well on that end. It's the best that we can do to kind of hang on and hope for the best there. You have anything to add, Ron? Or
I think that summarized it well.
all right, awesome. Well, all right, guys, let's open up for questions here. Feel free to type them in the chat or the Q&A box. Give it a few seconds.
I see a couple on there. I see one from, I think Karen's saying, I didn't catch what company Ron is with. Oh, and you can only see part of my sticker, I guess, but it's Steadily Insurance Company. We do investment property insurance, which includes both landlord insurance and builder's risk construction insurance.
All right, we have another question, looks like from Ben. Does Steadily offer dwelling coverage with light builder's risk endorsements?
Yes, we do. We have several options for it. It is it's actually more common of a policy than the true builder's risks that we write, because especially when you think between tenants, a lot of investors are doing at least some amount of work. Sometimes it gets into a little bit more of a light renovation. That's when you might want to look at one of those policies. But yeah, we offer several of them.
Okay. We have another question here. How should investors handle insurance when forming an LLC or other legal entities for property ownership? From a lender perspective, we do require that the actual LLC that we're closing under is listed as the insured. So we don't necessarily need anything as far as the forming of the LLC. Just when it comes to binding the policy, it does have to be bound under the LLC as the main insured. I don't know if you have anything to add from that perspective, Ron, from the insurance side.
Yeah, some companies are a little tricky in that they don't let you put the policy in the name of an LLC. Our policies do. They're built for real estate investors, so that's no problem for us at all. But you run into it sometimes.
Okay. Looks like Karen asked, who is the top carrier you recommend? We currently have Erie, but the double-digit rate increases are hard to take.
Well, I'm a little bit biased. Steadily, we are actually a carrier and an agency. So we write our own policies, and we also partner with a lot of other specialized companies that write this type of business. So because our goal is to be able to say yes to upwards of 90% of quote requests that we get. So if we can't service it on our products, we go to one of our partners. But Steadily, I really very much believe in the products we're building, the rates, et cetera. There's a lot of good companies out there. Some of our biggest partners, American Modern, Foremost is a great company. So those are a few that come to mind.
Okay, awesome. Do you know what the max dwelling coverage is that Steadily will write in California by any chance?
Yeah, a lot of companies are capping out pretty low, which is probably the impetus for the question. Seeing a lot of 500,000, which doesn't get you too far in California these days. You do have to remember, though, that we're just talking about the rebuild cost for the structure, and a lot of these properties in California, the value's in the land. So sometimes you're going to see a replacement cost that looks extremely low, but is actually appropriate. All that said, we've got a lot of options that can go up to a couple $1 million. It really depends on the area, how high risk of a wildfire zone it is. There's a lot of things that can limit the amount of companies that are available for a given property. But we operate in California all day and answer these types of questions. So definitely check us out, and one of our agents would be glad to help with a particular property.
Awesome. So we'll take one more question here. James indicated, what are Ron's thoughts on Western Florida and hurricane fire impacted markets in general? And should we expect that area to be expensive and difficult to insure for a while, or does it ebb and flow?
Unfortunately, it hasn't ebbed and flowed that much. It's just gotten harder and harder over the past few years. Florida is a market where I think we have 5 or 6 different carrier partners that we work through, and still it can be hard to find coverage for some properties, and they end up having to go with Citizens, the insurer of last resort. So it's just a really hard market. I wish I had some insight on how to make it easier there, but it's really about shopping. You want to make sure you check with multiple different carriers. Some can be twice as much premium as others. Some will decline while others will accept. Definitely check with a couple different brokers so that you make sure you get a large sampling before you land on one.
Okay, awesome. I think that is all the time that we have for questions today. We will make sure that you get our contact information and Steadly's contact information as well to follow up, get quotes, and we'll answer any questions that you guys have that we have not been able to get through here. Thanks again for joining us today for Weathering the Storm. I hope this gave you some practical insight into how to approach insurance as an investor and how to protect yourself and your capital in today's market. Once again, thank you guys so much, and we'll see you next time.
Thanks, everybody.